Sylvain, this is one of the central bank meetings that the market is watching very closely. Just flesh out for us what you're expecting to hear this time round. Just how hawkish, just how dovish will the ECB be?
Well, the ECB has a number of complex decisions to make, and it's not sure that all of them will be made today. It's more likely that the ECB will stretch out all the decisions between today and the Policy Council of February or even March. All the decisions are about reducing the pace of QE, not too much, not to be behind the curve also, but there is no rush for the ECB to make a decision on rates. It's a question of balance on reducing QE for the ECB today.
Right. The European market is a very unusual one. You've got a situation where there's very little tolerance for inflation, particularly from some countries. But you've also got governments that are willing to go with very tough COVID policies to tame the spread of the pandemic. We're just hearing from Germany that there are no red lines for the government. As you weigh up particular measures, what do you expect that to do to the consumption side, to the demand picture at this point? Do you think we will see a cooling off in some of the red-hot inflation pressures we've witnessed lately?
Well, there are two things. So on the one side, there are this fourth wave of COVID-19, which is delaying the recovery in services in the Eurozone, especially in consumer-facing services, and this will put some drag on GDP growth and consumption at the end of the year, beginning of next year. And then on the other side, there is a rise in energy prices more than something else that is cutting purchasing power in Europe. But that said, consumers are still have high savings. Governments have taken measures in Europe to lower taxes on energy prices. So yes, you will have a temporary decrease in purchasing power in the Eurozone at the beginning of next year, maybe over the first quarter. But then we expect consumption to remain the main driver of the robust expansion we should see next year for the Eurozone. And we expect consumer spending to increase by 6% next year.
But Sylvain, good morning.
More than next year, more than this year. Sorry.
I don't understand what you just said, Sylvain. I don't understand how you can tell me that there's going to be a robust recovery in the European economy in 2022 and at the same time not move on interest rates, which are at record emergency low levels until 2024. Something doesn't make sense, Sylvain.
The ECB can still be much more patient on rates than the Fed or even the Bank of England. And why is this? This is because we have in the Eurozone probably more than elsewhere a very smooth and rapid recovery of the labor force. The labor force participation is now back to pre-COVID level in sync with GDP. This is not the case in the US. In the US, GDP is above pre-COVID level, but the labor participation rate is 1.5% below, and it leads to wage inflation. That's not the case in the Eurozone. The wages in Europe, in the Eurozone, are growing at 1.5% this year. We will see a bit higher wages next year, but not to the point that it will outpace productivity. So if you look at the first rounds of wage negotiation passed for 2022 and 2023, a lot of them in Germany, they point to something like 1.9% increase in wages next year. 1.9. Productivity will be something like 3%. So there is no sign of wage inflation in Europe, and there will probably be no sign before the end of 2023. So once again, the ECB has time to hike rates. Probably the current guidance on rates for the ECB will not change a lot.